The country that falls first is not always the country that matters most. That is the mistake people make when they look at sovereign risk. They search for the weakest name, the ugliest inflation chart, the most desperate IMF meeting, the poorest government, the most fragile currency, and yes, that matters. But the larger question is not only who breaks first. The larger question is whose weakness forces everyone else to reprice reality. A small economy can collapse and become a tragedy. A major economy can wobble and become a global event. A reserve currency power can lose credibility slowly and change the rules of money for everyone. That is why this story is more dangerous than a simple country countdown. 7 countries are now showing warnings from the same family, different politics, different currencies, different histories, different levels of wealth. But underneath, the mechanism is the same. Governments borrow too much, growth fails to keep up, reserves weaken. Politicians delay the painful decision, central banks get pressured, the currency absorbs the lie, and then the public discovers the truth. A government does not have to formally default for your savings to be damaged. It only has to weaken the money you are saving in. That is the hidden thread connecting all 7 countries. Watch 3 things: debt, reserves, and discipline. Debt tells you how much the past is weighing on the present. Reserves tell you how long a country can defend itself from outside pressure. Discipline tells you whether leaders are willing to protect the currency when protecting it becomes unpopular. When all 3 weaken together, the clock changes speed. Bangladesh is the first warning because it does not look like the obvious crisis. Its debt is not the worst. Its story has been impressive. For years, Bangladesh lifted millions out of poverty and became essential to the global garment supply chain. It was a development success story, then the model met the wrong shocks. Exports weakened, energy imports became more expensive, the dollar strengthened, reserves fell, factories faced power interruptions, the machine kept running, but the room for error narrowed. That is the lesson from Bangladesh. A country does not need catastrophic debt to become vulnerable. It only needs the wrong dependencies hit at the same time. Imported energy, foreign demand, dollar pressure, falling reserves. That is how crisis begins before the debt ratio screams. Egypt is the second warning because it combines financial stress with geopolitical importance. Egypt controls the Suez Canal, but the canal does not protect the pound. It does not make imported wheat cheaper. It does not erase the political danger of food inflation in a country where bread is part of the social contract. Egypt's trap is brutally simple. A weaker currency makes imported wheat more expensive. More expensive wheat makes subsidies. More expensive subsidies widen the deficit. A wider deficit brings more pressure from lenders. Reform then touches food prices, and food prices touch political stability. That is why Egypt is dangerous. It is not just a debt story, it is a food, currency, subsidy, and stability story wrapped into one. The government can cut subsidies and risk public anger. It can keep subsidies and deepen the debt. It can devalue and make imports more expensive. It can defend the currency and burn reserves. Those are not clean exits. They are different versions of pain. Pakistan is the third warning because repeated rescue has become the pattern. A country can go to the IMF once because it was hit by a shock, twice because policy failed. But when the number becomes 23, the message is different. The problem is structural. Pakistan's real danger is not only that debt is high, it is that interest consumes too much of the state. Every rupee used to service the old system is a rupee that cannot build the next one. That means less investment in energy, productivity, infrastructure, and resilience. The country remains dependent on imported fuel. Imported fuel becomes expensive. Electricity prices rise. The public cannot absorb the full cost. The government subsidizes the difference. The subsidy is funded by debt. The debt creates more interest. The trap tightens without needing a dramatic headline. This is how a country gets stuck. Not because nobody understands the problem, but because every solution creates political pain faster than it creates economic relief. Turkey is the fourth warning because it shows how fast credibility can be destroyed. Turkey is modern. It is industrial. It is connected to global markets. It has institutions, banks, companies, and a central bank. Yet the lira suffered because leadership fought the basic logic of inflation. When inflation rises and the government pushes rates down, the market does not need a speech. It understands the incentive. The state is choosing short-term politics over the currency. Once people believe that, they act, they move savings, they demand dollars, they raise prices ahead of expected inflation. They stop trusting the local money as a store of value. That is the real damage. A currency is not only paper or digits, it is a belief system. And when a government breaks that belief system, raising rates later does not instantly fix it. Turkey matters because it proves a serious country can make a primitive mistake. Argentina is the fifth warning because its people know what happens when the rules of money are rewritten. Argentina has defaulted so many times that crisis has become part of national memory. People understand that a bank account can be frozen. They understand that the official exchange rate can become fiction. They understand that savings can be changed by decree. That is a different level of damage. In a normal country, citizens trust the rules until proven otherwise. In Argentina, history has taught people to question the rules before the next crisis arrives. That makes recovery harder. A reform program has to repair the budget and rebuild belief. It has to convince citizens that this time the state will not repeat the old pattern. Argentina's current experiment may succeed. Fiscal discipline may finally break the cycle. But the human cost is real, and the trust deficit is enormous. Once a country teaches its people that money is political, every future promise starts weaker. Japan is the sixth warning because it is the rich country version of the trap. Japan does not look like collapse. It looks calm, wealthy, organized, and advanced. That is why people ignore it. But Japan's debt is so large that normal monetary policy has become dangerous. For years, the system worked because most of the debt was held domestically. Japanese institutions held Japanese bonds. The Bank of Japan supported the market. Savers stayed inside the loop. That loop bought time, but the same loop created a problem. If interest rates rise too much, debt service becomes dangerous. If rates stay too low while inflation exists, the yen weakens and savers lose purchasing power. If the central bank protects the bond market, the currency can suffer. If it protects the currency, bonds can suffer. Japan is not a sudden collapse story. It is a trapped system story. And trapped systems are dangerous because they can appear stable for years, then suddenly force decisions nobody wanted to make. Then comes the United States. This is the name people resist placing on the list. The United States issues the dollar. The world uses the dollar. Central banks hold dollars. Global trade runs through dollars. Treasuries sit under the financial system like bedrock. That is real power. But it is not immunity. The United States now spends more on interest than on defense. That is not a small accounting detail. It is a signal that past decisions are consuming the present budget. Interest is not optional. It is the price of yesterday. And when yesterday becomes more expensive than national defense, the country has entered a different stage. The United States will not face crisis the way Pakistan or Argentina might. It creates the currency. The debt is written in. It has deeper markets. It has stronger institutions. It has global demand for its bonds. That means the American crisis, if it comes, is slower and more subtle. It looks like higher borrowing costs. It looks like foreign central banks diversifying reserves. It looks like gold becoming more attractive. It looks like political leaders discovering that every fiscal solution hurts someone powerful. Raise rates and the interest bill grows. Cut rates too early and inflation risk returns. Cut spending and politics explodes. Raise taxes and growth weakens. Print money and the currency loses purchasing power. That is the reserve currency trap. The dollar gives America more runway than anyone else. But a longer runway does not matter if the plane keeps accelerating toward the end of it. So who falls first? If the question is immediate stress, look at Pakistan, Egypt, and Argentina. They have weaker currencies, tighter external constraints, and less room to make mistakes. If the question is early warning, Bangladesh matters because reserves are the first oxygen line. If the question is credibility, Turkey has already shown how quickly trust can break. If the question is delayed reckoning, Japan is the quiet giant. If the question is the country whose fiscal deterioration would change the world, it is the United States. That is the uncomfortable answer. The first domino and the biggest domino are probably not the same. And that is why most people will misread the next crisis. They will watch the weakest country and ignore the largest assumption. They will treat sovereign collapse as a foreign problem until exchange rates, food prices, energy bills, taxes, mortgages, and retirement accounts tell them otherwise. Currencies survive on trust. Governments borrow against trust. Bond markets price trust. Central banks defend trust. When trust moves, it can move faster than expected. Bangladesh warns that reserves can fall before debt looks fatal. Egypt warns that food and currency can become one crisis. Pakistan warns that rescue can become dependency. Turkey warns that politics can break money. Argentina warns that governments can change the rules when trapped. Japan warns that postponement can become a prison. The United States warns that privilege is not the same thing as safety. 7 countries. One sequence, the country that falls first, will dominate the headlines. The country that matters most may not fall in a single day. It may simply make its money weaker, its debt heavier, its politics more trapped, and its people poorer in slow motion. That is how the biggest financial shifts usually begin, not with a bang. With a currency everyone trusted losing a little more trust than yesterday, and then doing it again tomorrow.